It's September 2008. Lehman Brothers, 158-year-old financial institution, collapses overnight, triggering a global panic. The Dow Jones Industrial Average plummets 777 points in a single trading session, shedding $12 trillion in market value. Fear grips the world, and a question echoes: will the entire financial system unravel? To understand what's happening now, we have to go back to that moment, to the solution that set the stage for a crisis brewing for 2026. Governments and central banks faced an impossible choice: let the system cleanse itself or intervene with unprecedented force. They chose intervention, deploying trillions of dollars in an effort to stabilize markets. The Federal Reserve slashed interest rates to near zero from 5.25% in 2007 to 0.25% by December 2008. They also launched quantitative easing, injecting over $45 trillion into the financial system between 2008 and 2014. This created an artificial demand for assets, preventing a deeper recession. The immediate goal was achieved. The global economy avoided a full collapse. But here's where it gets interesting. The patient was stabilized, but the underlying illness was never fully cured. It was merely sedated. The policies of 2008, designed to prevent immediate disaster, inadvertently laid the groundwork for future instability. They encouraged a new era of moral hazard, where risk-takers believed they would always be bailed out. Financial institutions deemed too big to fail only grew larger, consolidating power. By 2018, the top 4 U.S. banks held 40% more assets than they did in 2007. The injection of cheap money distorted asset prices across the board. Housing stocks and even obscure financial instruments soared, detached from underlying economic fundamentals. Average home prices, which bottomed out in 2012, increased by over 70% by 2022. This created a wealth effect for those who owned assets, while wage growth for many stagnated. In fact, real wages for non-management production workers only increased by 2% annually between 2008 and 2018. So what happens next? The world became accustomed to an era of perpetually low interest rates, and readily available credit companies borrowed heavily, not always for productive investments but often for stock buybacks. Corporate debt in the U.S. climbed from $85 trillion in 2008 to over $125 trillion by 2021. Governments, too, became addicted to cheap borrowing, expanding their balance sheets dramatically. U.S. national debt surged from $10 trillion in 2008 to over $30 trillion by 2022. And then everything changed. Inflation, once considered a relic of the past, roared back with a vengeance in 2021 and 2022. The Consumer Price Index, which averaged 18% from 2008-2020, hit a 40-year high of 91% in June 2022. Central banks, forced to confront this new reality, began hiking interest rates aggressively. The federal funds rate jumped from 0.25% in March 2022 to over 5% by mid-2023. This sudden shift exposed the fragilities built into the system over the previous 15 years. Companies and governments now face significantly higher borrowing costs, squeezing budgets. Many businesses that thrived on cheap debt are now struggling to service their obligations. Refinancing existing debt at these new higher rates is proving to be a major challenge. Which brings us to the core problem: a massive debt overhang created by years of easy money. This isn't just about corporate debt. It's about sovereign debt, household debt, and private equity debt. Globally, total debt increased by $85 trillion from 2008 to 2021, reaching over $300 trillion. What was considered a solution in 2008 has evolved into a ticking time bomb. Consider the commercial real estate market particularly vulnerable to higher rates. Many properties were valued based on low borrowing costs and optimistic rental income projections. With interest rates higher and many office buildings seeing occupancy rates drop from 90% pre-pandemic to 50% by 2023, valuations are collapsing. Estimates suggest over $15 trillion in commercial real estate debt matures by 2025, facing much higher refinancing costs. This situation echoes the housing bubble of 2008, albeit in a different sector. Banks, especially regional ones, hold significant exposure to these vulnerable assets. If these loans default, it could trigger a domino effect similar to the subprime mortgage crisis. Another area of concern is the proliferation of zombie companies, businesses kept alive only by cheap credit. These companies, representing 15% of all publicly traded firms in 2022, cannot cover their interest payments from operating profits. As interest rates rise, their viability diminishes rapidly, threatening waves of bankruptcies and job losses. The unemployment rate, which dropped from 10% in 2009 to 35% in 2023, could see a sharp reversal. The structural issues created post-2008 were never resolved. Instead, they were papered over with liquidity, creating a larger, more complex problem. The ability of governments to intervene again with similar scale is severely constrained. Public debt levels are already at historic highs, leaving less fiscal maneuvering room. Interest payments on the U.S. national debt alone are projected to exceed $1 trillion annually by 2026. Central banks also have less room to cut rates, having only just begun to normalize policy. The solution of 2008 created a global dependency on cheap credit, fostering malinvestment and excessive risk-taking. Now, as that dependency is being withdrawn, the system is revealing its cracks. This brings us back to 2026, the year. Many economists predict the convergence of these factors will reach a critical point. Commercial real estate maturities, corporate debt walls, and sovereign debt pressures will intensify. The very medicine administered in 2008 has produced side effects that threaten a new, perhaps more insidious crisis. We've seen similar patterns throughout history where short-term fixes lead to long-term imbalances. What we are witnessing is the delayed consequence of avoiding a full reckoning in 2008. The chickens of cheap money and suppressed risk are finally coming home to roost. The question is, will 2026 be a mild correction or a full-blown financial crisis directly attributable to the choices made 18 years prior? Some argue the system is more resilient now. Others fear the interconnectedness makes it more vulnerable. Which path do you think we are headed down? A manageable adjustment or a significant economic reset? Drop your prediction in the comments below and subscribe to see if you're right when we revisit this in 2026.